Welcome back to the deep dive. Today, we are strapping in for a deep examination of Palantir Technologies. That's ticker PLTR. And this is a story that really, it just embodies the massive and, let's be honest, often confusing shift happening right now in how we value software companies.
Absolutely. The old rule book is being thrown out.
It really is. If you've been watching the market, you already know the hook here. Palantir, an AI software specialist, had a truly, well, a stunning 2025.
Stunning is the word for it.
Its stock didn't just climb, it skyrocketed. Jumping an absolutely phenomenal 149%.
And that kind of explosive growth, it signals something. It tells you the market believes Palantir is poised to dominate this next generation of AI deployment. For enterprise, for government, for everyone.
Okay, let's unpack this.
Let's do it.
Because despite that, it's nearly a tripling of the stock price. Despite all the headlines, the sources we dug into reveal this incredible, almost jarring contradiction.
It's a huge one.
Wall Street analysts are surprisingly, you could almost say aggressively, lukewarm about the stock's future. It's like the pros are watching a completely different movie than the rest of the market.
And that tension right there, that's the mission of this deep dive.
Exactly.
You have a stock that has posted a 149% gain, and yet, when we look at the consensus view from the analysts covering the company, the outlook is, well, it's remarkably conservative. The median 12-month price target is only $200.
Only $200.
For context, if you, the listener, bought the stock today, that target amounts to a projected gain of just 6% over the next year.
6%.
6%. That's barely beating inflation. It's certainly not justifying the kind of volatility you absorb when you invest in a growth stock like Palantir.
And it gets even more skeptical than that, doesn't it?
Oh, it does. We looked at 27 analysts covering PLTR, and only about a quarter of them. Just a quarter rate in a buy.
So what are the rest saying?
The overwhelming majority, we're talking 2/3 of the total pool rate, it is flat hold. Which really raises the critical question for you, the informed investor. Why this deep skepticism when the stock is delivering massive, sector-leading returns? Is the street missing something fundamental about how AI companies are creating value?
Well, we know exactly what's driving that fear, and it all comes down to the most traditional and, arguably the least flexible metric in investing: valuation.
The price tag.
Exactly. Analysts are looking at the stock's recent surge, and they're immediately hitting the brakes because of what they're calling a lofty valuation.
Right. The sticker shock.
Let's put a number on that sticker shock because it's truly shocking. If you look at Palantir's trailing price to earnings multiple, the classic PE ratio.
The traditional way we measure how much the market is willing to pay for every dollar of past earnings.
Palantir is trading at a staggering 435 times trailing earnings.
435. It's a number so large it almost ceases to have meaning in conventional investing. Yeah. But we have to give it context.
We do.
When we compare that 435x PE ratio to the overall U.S. tech sector, the average earnings multiple is sitting at, around 45?
45. So Palantir is trading nearly 10 times higher than its own sector average.
On a trailing basis, yes. So from a traditional valuation standpoint, the analysts are completely justified. You can't blame them for rating this stock a hold. It is undeniably prohibitively expensive by conventional measures.
So if you're an analyst who lives and dies by PE ratios,
you simply cannot recommend a buy here. Your model won't let you.
But I have to push back on that a little. If that valuation is so astronomically high, why are we even talking about it? Are we just trying to justify an expensive stock, or is there a totally different way we need to look at this?
That's the right challenge. We can't just dismiss the PE, but we can't let it paralyze our thinking either. It's important to acknowledge that the sources do note the forward earnings multiple.
Right, the one based on future estimates.
Exactly. It does drop significantly, down to 188 times.
But even 188x is still wildly expensive.
Wildly. And that's why we have to transition the discussion. Because in the world of high-growth software and AI deployment, those valuation premiums, they can be justifiable.
But how?
They're earned not through traditional earnings, but through something far more specific: strong unit economics, high profitability, and incredibly efficient growth.
Okay, so when you say unit economics and high profitability, what's the one key metric we should be focusing on here that shows this premium might actually be earned?
We need to look straight at the adjusted operating margin. This is the metric that shows how much profit a company is making from its core operations.
Before taxes and all the other noise.
Precisely. It's a measure of pure operational muscle. And we saw this demonstrated profoundly in their Q3 2025 results. Their adjusted operating margin shot up by an impressive 13 percentage points year over year.
And where did it land?
at a remarkable 51%.
51%. An adjusted operating margin of 51% for a company growing this fast that's incredibly efficient. It tells you they're extracting serious profit from every dollar of revenue they bring in.
That's it. A 51% margin in the software world indicates a scalable product. It means their platform, their artificial intelligence platform, or AIP, is highly leveraged.
So it doesn't cost them much to add another customer.
Very little. And this margin, this profitability, is the counterweight to that absurd 435x PE ratio.
So, okay, if traditional valuation is basically out the window because the growth is just too disruptive, what metric are smart investors focusing on right now? We need something clear, something defined that validates paying this kind of premium.
We do.
And that leads us to the metric that truly defines whether this premium is warranted in the software world, the Rule of 40. This is the deep dive metric that often separates the high-flying, justified growth stocks from, the pure hype plays.
It's the metric that high-end software investors absolutely live by. It measures the balance between a company's raw growth and its profitability.
Because usually you have to sacrifice one for the other.
Exactly. In a high-growth environment, you often sacrifice margin for speed, or vice versa. The Rule of 40 says you need to be doing both and doing them well.
So let's define it clearly for the listener. The Rule of 40 is, well, it's a simple but powerful calculation.
Very simple.
You take a company's revenue growth rate as a percentage, and you add it to its adjusted operating margin, also as a percentage.
And if the resulting score is over 40%,
hence the name,
the company is generally considered a healthy, investable software company.
So a score of 40% is kind of the baseline for a good company, maybe 30% growth and a 10% margin?
Right, or 20 and 20. But anything over 40 is seen as excellent performance. A company hitting 60% is exceptional. They are likely a top-tier performer.
Or 80%.
A score of 80%. That puts them in a rarefied atmosphere. It signals almost unparalleled efficiency and market capture.
And this is where we have our aha moment, the moment that explains the contradiction we started with. Because when we run the Rule of 40 calculation for Palantir,
based on its Q3 2025 performance,
the result goes beyond rarefied. It's almost unbelievable.
Let's just run the numbers one more time for clarity. Palantir reported a 63% year-over-year increase in revenue for Q3.
63%.
We then add that to the 51% adjusted operating margin that we just talked about.
So that's 63% revenue growth plus 51% adjusted operating margin, which gives you a Rule of 40 score of 114%.
114%. It's not just good, it fundamentally shifts the entire investment narrative.
It's a different story.
This score argues that analysts relying solely on trailing PE are using the wrong tool for the job. It's like they're applying car valuation metrics to a rocket ship.
I just want to linger on that number for a second.
Yeah.
114. Is that an anomaly? A one-off spike that isn't sustainable?
Well, the growth rate suggests a massive acceleration, but not necessarily a one-time fluke. For context, this metric has expanded significantly for them over a very short period.
How so?
Just a couple of years ago, in Q4 2023, their Rule of 40 score was 54%. So they've more than doubled their efficiency and growth metric in less than 2 years.
Wow.
Management has, and you can't blame them, been very eager to publicize this. They noted that this 113% score actually ranks second among the top 25 companies globally when measured by this metric.
Second in the world. Who's number one?
You know the company ahead of them. NVIDIA.
That's fascinating. So Palantir is second only to the defining hardware company of the entire AI boom.
Exactly. And within their specific niche, Palantir stands alone. They are the top enterprise software company with more than $1 billion in revenue by this measure.
So the metric is a direct reflection of how fast their software is being adopted.
And the high margins they achieve once it's deployed. If we connect this all back to the bigger picture, this metric suggests Palantir's premium valuation, that 435 times trailing PE,
the one that scares all the analysts,
is indeed justifiable. The market is paying a premium for operational excellence that is virtually unmatched in enterprise software.
Okay, so the question then becomes, how do they maintain that unprecedented 114% score, or, even improve on it? To answer that, we have to look at the engine of future growth.
Which is all about their artificial intelligence platform, or AIP.
Is this repeatable?
It's entirely dependent on AIP. And the first key driver we see in the source material is pure customer expansion. That's the input.
Right.
Palantir's overall customer count increased by 45% year over year in Q3.
45% customer growth in a single year for these huge enterprise contracts is incredibly aggressive. But tell me about the business model. How does AIP translate that into sustainable revenue and those high margins?
That's where the unit economics come back in. The initial contract is just the wedge to get in the door.
Okay.
Customers tend to start with a limited contract for their AIP platform, maybe for a specific project or department. Once the client sees the power and the speed of it, they rapidly expand.
They get hooked.
They get hooked.
Mm.
The Palantir model means customers tend to expand their AIT deployments significantly after that first contract. This promises recurring revenue that accelerates, and because the platform is already in place, the margin on that expansion is incredibly high.
And that's how they're pushing that adjusted operating margin up to 51%.
Precisely. The platform sells itself once it's in the door.
But the truly critical indicator of sustainability isn't just the current growth rate. It has to be the future pipeline.
Absolutely. The even stronger indicator of future performance and why that 114% Rule of 40 score is likely to hold or even improve is the massive jump in new contracts being landed right now.
This is the fuel tank.
This is the fuel tank.
Ah.
Palantir secured $2.8 billion worth of new contracts in Q3 alone.
$2.8 billion.
That's new business being added to the pipeline, and it represents a 151% increase from the year-ago period.
151% pipeline growth in one quarter. That growth rate is just staggering, and it suggests a much, much stronger revenue pipeline for future quarters. The backlog is huge, and it's accelerating faster than their actual revenue is right now.
That is the very definition of momentum. And we also have to contextualize the sheer size of the market they're competing for.
Yeah.
Palantir is emerging as the go-to choice for governments, for major enterprises that are urgently trying to deploy AI tools effectively and securely.
Which is their specialty.
It's their specialty. And the market opportunity here is massive, and it's growing exponentially. The global AI software market is estimated to be around $126 billion in 2025.
And where is it going?
It's expected to bloom to nearly $400 billion by 2030.
Okay, so that's about a 25% annualized growth rate for the entire market.
Right.
So if the whole ocean is growing at 25% and Palantir's pipeline growth, that 151% jump, is so far ahead of that, they aren't just riding the wave. They are vacuuming up market share faster than almost anyone else.
They really are.
Now, we have to bring this discussion back to the person listening. What should you, the investor, do with this? Because the reality remains, buying Palantir now means paying a massive industry-leading premium. That risk is baked into the price.
That risk is very real. You're betting that the future performance will continue to justify the current price, which requires near perfection. But their track record suggests they are capable of delivering that perfection.
Exactly. Before you just dismiss it because of the price, you have to look at the company's ability to consistently exceed expectations. In Q3, their actual earnings jumped 110% year over year to $21 per share.
And that wasn't just good.
No, they soundly crushed Wall Street's estimate of $0.17 per share. They're delivering operational outperformance that traditional analyst modeling just seems unable to capture.
It's like those old models, the ones based on historical PE multiples. They just break down when you have a 114% Rule of 40 score.
They can't process it.
Which leads directly to the future outlook. Even with their conservative mindset, analysts are forecasting a hefty 40% increase in earnings in the new year, 2026.
40%?
However, based on that robust $2.8 billion revenue pipeline and the consistent addition of new customers, which, as we said, inherently boosts margins, Palantir could easily exceed that 40% forecast.
So 40% earnings growth could be a floor, not a ceiling.
It very well could be. If they maintain a Rule of 40 score anywhere near 100%, that seems very possible.
And that score, which is already among the highest in the world, is likely to continue improving or at least stabilize at this massive level. It's all thanks to this incredibly lucrative and still relatively new generative AI software market.
Palantir's positioned right at the bottleneck, where massive data meets actionable AI.
Here's where it gets really interesting. If Palantir continues to leverage that $2.8 billion contract pipeline, continues at 45% customer acquisition pace, and maintains this unprecedented operational performance, the stock could continue soaring in 2026. It could blow right past those conservative analyst price targets.
Which would make it a viable consideration for anyone seeking that extreme but justifiable growth.
Even if it means clearing that massive valuation hurdle to get in, you are paying for a best-in-class machine.
At that point, the conversation stops being about valuation and starts being about market dominance.
So what does this all mean? We started with this massive tension, analyst skepticism based on traditional rigid valuation metrics like that 435x PE,
Right, running headlong into these unprecedented operational efficiency metrics.
Specifically, the 114% Rule of 40 score and that massive accelerating pipeline growth with $2.8 billion in new contracts. The analysts say hold because of the price. The metrics say buy because of the performance.
The investment implication is clear. You are paying a huge premium for world-class, almost peerless performance in the enterprise AI space. The question is whether that performance is sustainable enough to make today's premium look cheap tomorrow.
It's a big question.
But let's leave you with one final provocative thought to consider as you watch this AI race unfold.
Okay.
We noted that Palantir's Rule of 40 score, measuring efficiency and growth, ranks second globally, behind only NVIDIA.
All right, hardware giant.
The hardware giant. However, Palantir is the undisputed top enterprise software company by that same metric.
Right.
So this raises an important question for you to consider. In the long run, will the market begin to value the pure efficiency, the deployment speed, and the deep entrenchment of the go-to AI software company Palantir more highly than the underlying hardware provider NVIDIA?
That's a great question.
Or will the sheer, undeniable scale of the hardware market always cap enterprise software's premium, forcing Palantir's multiple to eventually contract back toward the mean? That's the ultimate battle of efficiency versus scale that you are investing in.